This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil prices clawed back some gains on Monday after hitting 5-month lows in the previous session as investors hoped potential talks between the presidents of the US and China could ease trade tensions between the world's two largest economies and oil consumers. Brent crude futures rose 87 cents, or 1.39%, to $63.60 a barrel by 0045 GMT after settling down 3.82% on Friday to the lowest since May 7. U.S. West Texas Intermediate crude was at $59.77 a barrel, up 87 cents, or 1.48%, following a 4.24% loss to reach its lowest since May 7.
U.S. oil may end its bounce below resistance at $60.58 per barrel, and retest support at $58.27 thereafter. The bounce is classified as a pullback towards $60.58. A wave C from $62.89 looks incomplete. It is expected to travel to $56.84. A break above $60.58 may trigger a gain into $60.58, $61.46 range.
Moving on to the top news in the energy sector.
U.S. energy firms this week cut the number of oil and natural gas rigs operating, the first reduction in 6 weeks, energy services firm Baker Hughes said in its closely followed report on Friday. The oil and gas rig count, an early indicator of future output, fell by 2 to 547 in the week to October 10. Baker Hughes said this week's decline puts the total rig count down 39 rigs, or 7% below this time last year. Baker Hughes said oil rigs fell by 4 to 418 this week, while gas rigs rose by 2 to 120, their highest since August.
China imported 47.25 million tons of crude oil in September, down 4.5% from 49.49 million tons in the previous month, according to data from China's General Administration of Customs. Imports of oil products rose 18.3% to 3.95 million tons, while exports of oil products fell 3.6% to 5.14 million tons. Next, we have the top news in metal markets. Gold prices climbed to a record high on Monday, driven by safe haven demand on fresh U.S.-China trade concerns, while broader economic and political uncertainties and expectations of further U.S. interest rate cuts also lent support. Spot gold was up 0.6% at $4,043.14 per ounce, as of 0059 GMT, after hitting an all-time high of $4,059.30 earlier in the day. U.S. gold futures for December delivery gained 1.5% to $4,059.60. Trump on Friday imposed additional tariffs of 100% on Chinese exports and announced new export controls on critical software effective November 1.
Iron ore futures fell on Monday on concerns over renewed Sino-US trade tensions, although the remaining firm demand in top consumer China, coupled with hopes of more stimulus from Beijing to counter the hit to its economy, curbed losses. U.S. President Donald Trump unveiled additional levies of 100% on China's U.S.-bound exports, along with new export controls on any and all critical software, by November 1, 9 days before existing tariff relief is set to expire. Trump's sharp tariff hikes, ending an uneasy truce between the world's two largest economies, came after China announced to expand restrictions on rare earth elements, essential to semiconductor and defense sectors.
We will now look at the top news in the agricultural sector.
Malaysian palm oil futures opened more than 1% lower on Monday for a second straight session, tracking weakness in rival Dalian oils, though stronger crude oil prices and Chicago soy oil limited the losses. The benchmark palm oil contract for December delivery on the Bursa Malaysia Derivatives Exchange slid 61 ringgit, or 1.34%, to 4,483 ringgit, $1,062.07, a metric ton in early trade. That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.